Thank you, Madam Chair. Thank the witnesses, members of the panel. Thank the chair of the full committee. Let's start with acquiring a better understanding of what the auction rate security is. We're talking about a long-term bond that has short-term interest rates that are reset about every 28 days, and they are reset as a result of a auction process. Now, when we say that it fails, that we had a failure of an auction rate security, what does that mean? In essence, what happened in the technical sense, in the procedural sense? What happened? Some folks showed up to bid, or what happened?
There aren't enough buyers.
And when you have a dearth of buyers, how does that impact the sale itself, the actual?
The holders continue to hold the security. There's no sale. So you continue to hold the security, and if in a failed auction, the interest rate typically goes up. The interest rate paid to the holders gets higher, and it goes high enough, in theory, that the expectation is that there will be an incentive at the next auction for there to be buyers or for the issuer to restructure because it's an expensive.
Would you define holder for me, please?
It's the people who bought the securities in the past auction and who bought and held them.
The person who purchased initially in this process in the past auction when they had a failure and you didn't have enough buyers, that person had a smile and said, wow, my interest rate just went up.
If what they're looking for is interest rate, that's
yes.
right. The interest rate went up. If they're looking for liquidity,
right,
they have a frown.
But if the interest rate is important, then that was a good thing for this person. Interest
Absolutely.
rate just went up. Does it go up exponentially?
It goes up depending on the type of security, whether it's a corporate or whether it's a student loan.
That's a good point. Let's talk about the type. Individuals can purchase auction rate securities, correct?
Yes.
And you have classes of individuals. You have the average Joe, person like me, who might have $25,000 that he scraped up and he buys. And then you have a wealthier class of individuals as well. Two
Yes.
classes? And these individuals who are holding long-term bond, short-term interest rate goes up. Initially, the impact is not adverse to their best interest if they're not interested in immediate liquidity.
If they're not interested in liquidity, they have earned a higher interest rate. That's correct.
So it's the liquidity that creates the problem in terms of persons coming in and say, hey, I need my money now.
Exactly.
And would like to have the interest rate that you promised me as well. And that works pretty fine. It works well as long as everybody doesn't show up at the same time, usually. Is this one of those cases where if some show up and say, I need my money, it's okay, but if you have a great number to show up, you have a problem?
No, it is an auction, and so the people who want to sell arrive through their broker-dealer at a certain date, and there have to be enough purchasers so that they can all be liquidated at the same time.
Okay. Now, moving forward to the process, continuing with this, we have in this process a group of people who are known as broker-dealers. Is that correct?
Yes.
Okay. And the broker-dealers, they work with the investors?
Some of the broker-dealers just sell the investments. They're the sort of secondary ones that Ms. Merrill was talking about. Some were also underwriters and participated in structuring the products in the first place.
Do the broker-dealers come into contact with the average Joe who had the $25,000?
Yes.
Okay. These are the people who, in a sense, engage in some sort of marketing process, whether it's secondary. There may be a primary marketer that gets me in. They are secondary, tertiary, or maybe even quaternary in the process, but they're in the process.
Yes.
And these broker-dealers are allowed to see the investor's bid before the bid is submitted.
Yes. I think that's right.
Yes.
Yeah, they see the bid.
Yes.
Yes.
Now, if they see the bid before it is submitted, can that, not saying it does in every case, but can that have an adverse impact on the process?
That was that was the subject matter of the action we brought in 2006, that is the auction practice itself. And as a result of that action, those who run auctions and who settled in 2006 were required to disclose their auction
Do
practices.
this because my time is up. Do this for me. Tell me what is the adverse impact of the broker-dealer actually knowing what the bid is before it is submitted.
There's
Tell me that, please.
possibility that there could be favorable treatment and negotiating towards a price where sort of to the middle, if you will.
Okay, explain that, please. This is an important aspect of it. What actually happens here? Because here we're getting to the heart of this. It's about deception, if not fraud. Explain to us, please.
In the auction rate process, the broker-dealer who sort of, if you will, underwrote the security had two interests that were of interest to that broker-dealer. One was the issuer. The issuer's interest is to raise capital at the lowest price possible. The other is the purchaser of the security, who of course wants the highest interest rate possible. And not to overgeneralize, but in the case involved in 2006, we found conduct by broker-dealers that was undisclosed to the issuers or the purchasers, that was trying to get the price, if you will, into the middle, trying to prevent failed auctions as well as holder auctions where no one was willing to sell, and to get an interest rate that was, if you will, in the middle.
Thank you.
I thank you, and the gentleman from Colorado is now recognized.
Thank you, Mr. Chair, and my friend, Mr. Green. He and I are always on the same wavelength, and he's asking a lot of the questions that I'd like to ask, because there's a microeconomic kind of a transaction piece to this. There's a macroeconomic piece to this, which is what's the whole world doing with these things. And then there is either the marketing piece, which can be either fraudulent or accurate or whatever. So I just got to say there's sort of four truisms that I have to mention before I get my questions. If it's too good to be true, it generally is. If something has to come to an end, it will. Res ipsa loquitur, the thing speaks for itself. And the last one right up there, e pluribus unum. And I want to start with that piece because, and I want to focus this on my chairman and also the ranking member. The problems that we have in the financial market today are gigantic. This is one sliver of it. And when we have good times, we can be many and do all sorts of things on our own, and we'll be fine. When we have tough times, and we are in tough times, we're in the vortex of some kind of financial hurricane that none of us understands. We come together, and it's going to take a lot of challenges and a lot of work and a lot of sacrifice on the part of everybody here is going to have to pick up the pieces, and millions of people across this country. And this committee, because of I think the bipartisan nature and the way that our ranking member and our chairman work together, we're going to be able to help America get back on track. So the res ipsa loquitur, for the lawyers on the panel and for everybody out there, the thing speaks for itself. This apparently turned out to just be a mess, because on one day we have people investing in these kinds of instruments, and the next day $330 billion, or whatever Mr. Galvin said, is gone. And these auctions go from 2% to 22% to try to make these things move. So let's go to the microeconomic piece. And my mom comes in, his average Joe. My mother comes in, she wants to buy $10,000 of these things. She's told, okay, you're going to buy a long-term bond, and you're going to get interest rate X, and you ought to be able to get out of this in 30 days. Or did they say, you will get out of this in 30 days? What was the promise that was made by the middleman?
It depends person to person, obviously, but by and large, I think our evidence suggests that these were marketed as you can get out of it anytime you want. It's as good as cash.
Okay.
And it provides a slightly better interest rate.
But I would say there is some responsibility on my mother's part to say, wait a second, I'm buying a long-term bond, I'm getting this little higher interest rate, and I'm promised this liquidity. At the end of the day, I'm still buying a long-term bond, right?
Don't be so sure that's what they were told.
Okay.
I'm not sure
Sometimes they
that,
didn't even know they were in an auction.
yeah, I'm not sure that investors were told this is a long-term bond with a reset at a short term. I'm not sure they were told anything like that. I think they were, in many cases, told, here's a cash equivalent, maybe like a money market. You'll be able to get your cash out every 7 days or every 28 days, whatever the auction period was. So I'm not sure they actually were told this is a long-term bond with a short-term interest.
Then it was a fraud
future.
from the outset.
It depends person to person and sales practice to sales practice. We have seen instances where people did understand that it was a bond, that it was set at auction, but they understood that they were getting a higher interest rate, a slightly higher interest rate than, say, a money market fund, because they were giving up liquidity for 7 days.
All right, but so now let's go to the macroeconomic piece of this. Who was buying this stuff? Was my mother buying this, or was this China buying this, or who was buying this? And why did they stop buying it? Because they saw the potential for deception, or something else? And I know you're all on the enforcement side of this thing, but who was buying it and why'd they stop?
The investors were both retail and institutions. There were more retail investors in terms of number than institutional investors, but the amount was split about 50-50 between them. Well, it's always difficult to tell the reasons things seize up. Beginning in 2007, as the subprime credit crisis hit, there was softness in this market. That was not necessarily transparent to the investors. But one of the things that happened the other thing that happened is that this market grew relatively dramatically. In 2006, the amount of outstanding was over 200 billion. By 2008, when it froze, it was over 300 billion. That's a lot to absorb. And then in January of 2008, the monoline insurers that sort of back these securities were downgraded, and that affected, to a certain extent, we believe, people's perception of the credit worthiness of the security. And so it was not very long
would that be
after.
the AIG or some other organization saying we're going to
BIA, yes.
not only is this a good investment, but we're going to ensure it's a
Yes.
great investment, so then the insurer goes down, people start getting nervous. Now, were there any big blocks of purchasers? I mean, I want to know if there was a lot of foreign investment that stopped and really started this house of cards tumbling. So we've got a fragile economy, a fragile market, but it was just generally everybody stopped.
I don't believe so. What happened was that for them, increasingly beginning in the summer of 2007, the underwriters were coming into the auctions to keep them from failing. So they would put in bids, so there were no failures, which meant that they were taking on more of these securities onto their books as they were becoming less liquid in a time when they were having a hard time carrying illiquid securities. And I think they hoped at some level that the market would recover and they wouldn't have to keep doing this. And by February, in combination with the monolines, the pressure became so great that they simply stopped supporting the auctions.
Okay, thank you.
The gentleman from California, then the gentleman from Missouri.
Thank you. I'd like to digress for a bit here, Ms. Thompson, to talk about not securities that are pretty close to complying with SEC laws or laws administered by the SEC, to a different issue. Is the SEC authorized, and does it have people who are pretending to be investors and dealing with all these investments out on the internet, et cetera, that are just obviously, blatantly in violation of securities law?
We do not, we cannot operate undercover. We can't pretend to be anything
And
other
that
than
is a failure of Congress to give you that authority, or is that also a failure of the SEC to ask for it?
I believe it reflects the fact that we are a civil law enforcement agency, and that we
So
work
if we
with,
want to focus on legalisms, and we've always done it that way, and we're just civil, then we can have a circumstance where no one is protecting the investor who is so unsophisticated that they're willing to invest in something that is an obvious violation of securities law. The reason I bring this up is it's by no means clear that anybody in this room is going to protect really smart people from themselves. The one thing we know the government can do is protect the ignorant. But you don't want to, or you're not in that business, and justice doesn't want to either, and Congress doesn't want to do anything about it.
actually,
And so, as much as we can talk here about exactly who was an inch over the line, the people who are 10 miles over the line are pretty safe. I'll let you
well, I hope
respond.
not, and it's our effort to not keep them safe. I was going to say that we work with criminal authorities when they can go undercover, and one of the things that I put in my submitted testimony is while we have been focusing on auction rate securities and what we've been talking about, we brought 380 some other cases during that same time period, and included among them are some really, frankly, outrageous Ponzi schemes.
If you're not pretending to be an investor, if you don't want to be in criminal law enforcement, if you don't, because I'll tell you right now, my local DA's got crime on the streets. He doesn't exactly want to focus on crime on in the suites. And you're here to talk about how we're going to protect the smart people, and I wish you were here saying we've got to have your people pretending to be unsophisticated investors and cleaning up the part of this that we can clean up. Now shifting to the purpose of, I will introduce legislation, but without SEC support, I'm going to have to be even more persuasive than my usual level of persuasiveness, and I probably won't be successful. Now, what's happened here is that the market is underpriced risk. They achieve this by ignoring risk and telling others to ignore risk. And in particular, today's hearings focus on 30-year bonds issued by private corporations, and they're priced in the market as if they're treasuries or insured deposits. Now, the issue, one view of this is widows and orphans were sold a bill of goods by smart people who knew better. But as far as I can tell, all the smart people on Wall Street thought these were accurately priced. Was anybody selling these short in a big way? Was there anybody smart enough to say the market has massively underpriced the risk here?
I believe you can sell these short.
What?
I don't think you can sell these short.
Okay. Was anybody investing, say, selling short the stock of the monoline insurance companies who insured these? Was anybody smart enough to realize that these things were not priced correctly and there was money to be made because the market was dumb?
I don't believe we have evidence of that.
So we're in a situation where, yes, it's true, individual investors may have been told, hey, it's as good as cash, or almost as good as cash, or really what you're saying is it's only 100 basis points, it's only 20 basis points worse than a treasury, and you're getting 25 basis points in return for that. The fact is the smartest people on Wall Street seem to have believed this utterly false tale.
I'm not sure I would go that far, because I believe that in those who underwrote, beginning in the summer of '07, knew what was happening in the markets, knew they had to go in, knew that liquidity was
But
failed.
they were buying these. I mean,
Time has expired. You can finish the answer, but we're over.
okay.
I think that those who underwrote understood that the liquidity feature was being undermined and degrading as they continued to sell them.
The gentleman from Missouri.
I like Dan Quayle. Let me just make an announcement. Dan Quayle's grandfather was a very prominent and profound Methodist bishop. There are Quayle United Methodist churches all over the state of Kansas and Oklahoma, Quayle buildings on college campuses, Methodist college campuses. Dan Quayle was not quite so profound, however, as his grandfather. In a speech trying to make reference to the motto of the United Negro College Fund, which is, "A mind is a terrible thing to waste," Vice President Quayle got a little mixed up and said, "It's a terrible thing for a man to lose his mind." And I happen to agree with him. I'd like to misquote him some more. "A crisis is a terrible thing to waste." I think that we are in a major crisis, and I don't think anybody who can read or hear would contradict that statement. And I think that if we're going to go through all of this pain, we need to come out on the other side having made some adjustments and changes, because a crisis is a terrible thing to waste. And by that I mean I'm wondering whether or not we need maybe a new kind of an enforcement structure that will deal with these knotty issues that keep cropping up, in addition to some stringent regulations. And I'm interested in your comments. But for example, many of the ARS contracts actually allowed broker-dealers to see investor bids before they were submitted to the auction agent, which of course gave the broker-dealers an unfair advantage. And if that is legal, wouldn't it suggest that there is a need for some serious regulations? And then, of course, as has been discussed widely this morning, some investment banks actually sold products as cash equivalents. And if that is legal, we need some strong regulations. So I actually have one question with a couple of components. And the first, I think, is do you agree that now is the time for us to deal with this crisis and come out on the other side with regulations? And then secondly, is there a need for a new enforcement arm? Not all at once, but...
Well, let me start by saying I agree with you that a crisis is a terrible thing to waste. You can learn lessons from it and decide what, if anything, you should do differently. With respect to a new enforcement model, we're here because the enforcement tools we have allowed us to bring enforcement actions in this arena. We were able to get this liquidity back to investors on really very, very short order because the behavior was illegal and because we worked together. So I think in terms of enforcement tools, we have we had some pretty good ones, and we used them well in this instance. That being said, I always love more, but I think it's fair to say that in terms of the enforcement tools that were available to address this problem, they were adequate to the problem, and I think the combined efforts of everyone you see here and the hundreds of people who aren't here using them was used to good advantage.
No, I appreciate the fact that the Attorney General's forced a buyback of some of the ARSs. I think that was good. But then the second part comes in, and that is there a need for some stronger regulatory components for enforcement? I mean, I know,
Yeah.
but before you answer, you know, if you answer the phones in our offices, whether you're a Republican or Democrat, people are angry all over this country. And I'm not sure how many people want to go home and stand up in front of a crowd and say, well, you know, we had a couple of little problems, and they'll work themselves out. You know, the market always is self-correcting. I mean, people want to know, number one, are the people who violated the law going to have to pay for it? And then secondly, is this going to happen again? Have you guys done anything to make certain that this doesn't happen again?
If I may
Merrill.
respond to that, first of all, I completely agree with you that the financial crisis that we see all around us today is something that we have to take advantage of in terms of reforming our regulatory system. Our CEO, Mary Shapiro, has talked about the fact that the regulation of this country, the way we regulate financial products, has to be fixed. It's a patchwork. Often it is split on product lines, and yet when you talk to a consumer, the consumer isn't split on product lines. In other words, they need an insurance product, they need securities, they need bonds, and they don't want to hear that a different regulator is in charge of each one of those different aspects of their entire financial health. So we do have to do something to fix that sort of alphabet soup of regulation that we have. In terms of the enforcement piece, I'll just take another adage. I don't know if Dan Quayle's used this one, but an ounce of prevention is worth a pound of cure. And I wouldn't look for a new enforcement arm. I'd go back and look at how could we have been smarter about seeing these issues before they came to the enforcement front. And that's where we've spent time internally looking at what can we do on our examination program when we're in firms, when we go in to examine our member firms, what should we be looking at to see how they're marketing products? Should we be looking at products that people have been thinking about as safe for 20 years and really digging down into some of those products? We spend a lot of time looking at the way firms market very risky and very complex products, derivative products. But I think what we're seeing in this crisis of the auction rate securities is that even something that's marketed as good as cash, something that was perceived to be by the firms to be relatively simple, isn't always as simple as it seems.
Ms. Coakley, I'm interested. I mean, you've taken people to court.
We actually didn't, because when we went to Merrill Lynch and UBS and said, you've broken law under Massachusetts, you cannot sell these kinds of auction rate securities to municipalities, it's illegal, they said, okay, we better pay you back, which is what they did, so we didn't have to sue. My answers to your questions are yes and yes. I've forgotten what the questions were, but I knew I had the answers at the time you asked them.
Well, you know, in my time on this committee, you're the first person since I've been here who's answered the question directly and quickly. I've been waiting for you for years. Thank you. Mr. Galvin.
Thank you. I think you touched upon one issue in your question. That's clearly, I think, the conflict of interest issue when you spoke of the bids being revealed. And I think that's something that has to be addressed. There has to be, in my opinion, and this would be a regulatory change, there has to be much stronger and direct regulation relating to conflicts of interest, not just in auction rate securities, but in a broader way. Secondly, I think the concept of a fiduciary duty, especially in the case of those that would actually be selling these, and this gets to the sales practices issue, there has to be some duty imposed upon the seller to be aware at least of the circumstance of the buyer, and whether that's cast in terms of disclosure, which many of us have spoken to, or an affirmative obligation to say that if you know that that person left your office is in your office believing this is liquid and you know it's not, you have an obligation to disclose that to them, and you should not sell it to them if you know it's not in their best interest. Those are some specifics. I think on the enforcement side, you can rearrange the structure. I think the this instance here demonstrates that I think the structure has worked collaboratively rather well. I think the bigger problem, as has been mentioned by Ms. Merrill, is the anticipatory side of enforcement. In other words, when you have an enforcement action, you've already had a failure. You've had something go wrong. There has to be something done on the other side to anticipate problems with products that are out there. There has to be a review of products that are out there. As I said, I think what has clearly been discredited, you spoke of a crisis, and there's no question that there is. What has clearly been discredited, in my opinion, is this idea that the free market is going to figure this all out. Products will fail, no one will ever buy them again, and it's corrected itself. Not without great loss. Not just the individual loss to the people who've been away from their money for a long time, but to the collective economy of our country. This money that's been tied up, whether it's individual money, small business money, or institutional money, has money that could have been working in our economy during this very critical time, and it wasn't available. So I think it's got to be an anticipatory enforcement as well as an enforcement after the fact.
Your answer is yes, too.
Yes, yes.
Thank you.
Thanks, Mayor. I thank the panel. We'll move on to the next panel now. I apologize, but, oh, I'm sorry, Ms. Spear. I didn't see Ms. Spear. The gentleman from California is recognized for 5 minutes.
Thank you, Mr. Chairman. I'm going to try and focus my questions on 3 areas: professional misconduct, cost recovery, and the enforcement activities going on in states other than Massachusetts. My hat's off to you in Massachusetts, an outstanding job. I worry that we're not doing what you're doing in Massachusetts around the country. But first, let me move to professional misconduct. As I look at the description of your organization, FINRA, Ms. Merrill, it's a little unnerving to me. It's a self-regulatory regime based on something we took off your website, that your focus is on registering and educating, and you're dedicated to investor protection. Now, based on what we've heard today, the use of auction rate securities was only used by sophisticated institutional individuals since 1984. And then 3 years ago, that was changed, in which it was opened up to less sophisticated investors who had $25,000 or more. Now, who made the decision to reduce the requirements as to who could get into these auction rate securities? And maybe this goes to Ms. Thompson and to Ms. Merrill.
Yeah, I'm not sure that the level of $25,000 was only lowered 3 years ago.
It said a few years ago in our packet.
But it is true that the auction rate securities market originated as being sold primarily to institutional investors. The $25,000 level is something that is set by the issuer, I believe, in terms of what they will allow as the minimum amount that can be purchased at the auction.
If that's the case, the issuer can do that on their own. Doesn't it seem appropriate for you to then, interested in protecting investor interests, to require greater disclosure to those investors that are less sophisticated? And why didn't you?
For every security that's sold by a broker-dealer to a customer, for everyone that's recommended, our rules, our suitability rules, require that that broker-dealer makes an affirmative determination that the product is suitable for that individual investor. And they have to take into consideration things like the risk tolerance of the individual, their investment horizon, their need for liquidity. And if they don't do that, then we bring cases against brokers. We've brought over 500 cases against individual brokers who have, just this year alone, against individual brokers who have recommended unsuitable investments to their individual clients.
I have only 5 minutes, so I'm going to cut you off just ever so briefly. Do you have authority to file any action against individual brokers to take their licenses away from them?
Absolutely.
Have you done that in this particular scenario with the auction rate securities?
In the auction rate security area, we started with the companies, with the broker-dealers themselves, because they're the ones who can supply the solution that we really wanted, which is to buy back investors' money. But we have not stopped, and we are continuing our investigation as to individual brokers, and where we find that there have been misrepresentations and suitability violations, we do have the tools, and we've used them again and again to bar people from the securities industry
For how long?
permanently.
Permanently?
Permanent bars.
And how often have you used that?
We've used it we have over 300 permanent bars this year alone, and another 200 and some suspensions on top of that.
But none in the auction rate securities
But
area.
our investigations are not complete.
All right. Let me move on to cost recovery. How much did it cost you to do your investigation, Ms. Thompson?
I don't know the answer to that, but other than the cost to our budget, if you will, of deploying our resources, this did not cost the government anything.
Well, but it did.
Obviously, wherever we investigate, we're not investigating somewhere else.
Do you have the authority to seek cost recovery from the entity that you find has done wrongdoing?
No. But we do have the authority, and we use it to get penalties, which go back either to the government or in fair funds to investors. We have not yet sought penalties in these matters because we wanted to make sure that all available resources were being used to recompense investors, and because we deferred the issue of penalty until the end of the process to make sure that the firms had actually stayed true to their word and had made investors whole.
I think for the American public, they're less concerned about making sure that the money just gets back to the institutions. I mean, they certainly want the money to come back to them as individuals, but they also want people disciplined. And they certainly don't want the taxpayers of this country to pick up the tab to have to do the investigation of folks that weren't complying with the law to begin with. And that's why I believe you should have the authority for cost recovery, and why I would seek to have our committee look at that issue.
The gentleman wants an additional 2 minutes. If you want an additional 2 minutes, go ahead.
All right, thank you. And to you, Attorney General Coakley, impressed by what you did in Massachusetts, to you, Secretary of State Galvin. I worry that unless states have taken on this, that there are many institutions and individuals who are not going to be made whole. I'm curious as to whether or not the U.S. attorneys around the country have engaged, and if not, why not? And would like your thought on whether or not there should be some nationwide class action brought.
Whoa. Well, in a nutshell, you know, the SEC as a federal agency has regulatory authority over institutions, and in many instances, states are preempted from banks and regulatory authority there for a long time. We have approached it from the point of view of what our own state statutory authority lets us do. We have a False Claims Act. We have Chapter 93A that does consumer protection. And we have a statute in Massachusetts that says you can't sell to cities and towns products like this that aren't liquid. So that's the basis on which we were able to go forward in this instance. But I think your question actually redounds to what the chairman's comments were at the beginning, that when we look at the overall picture here in terms of the auction rate securities and predatory lending and all of these pieces, I think Secretary Galvin and I would be strong voices along with the chairman to say we need a strong federal regulatory scheme, we need strong enforcement, including whatever else you think in terms of cost recovery, but you need to allow states, depending upon how much of this activity takes place in the state, what's the interest of that legislature, that enforcement, to be able to work in a very complementary way to look at from the ground up what's happening. And I think in this instance, the states, it's not only Massachusetts, New York has done a lot, California's done a lot. That's where a lot of this activity takes place and where these financial houses live. But that whole piece of how we're going to do this has to, I think, be approached with the state piece of it, not preemption for us, and let the states do what they feel they need to do.
Just to put your mind at ease, the North American Securities Administrators Association has taken this on and has worked with the Securities and Exchange Commission. And while state entities have brought individual actions, they have been representing the national interests. So in other words, it's open to every state. And indeed, even in the fining structure, that is the penalty structure, some states that were not lead states will still get some fine as a result of this. So for instance, when Massachusetts negotiated with regard to Bank of America, we negotiated for all Bank of America customers throughout the United States, and the agreement we secured from Bank of America was applicable to all customers. Similarly with Fidelity, which was a downstream broker, which we just entered agreement with last week. That's for all of Fidelity's customers. It's not limited to Massachusetts customers. So there has been a comprehensive effort here on the part of the states, but I think the concern is that, what about the next time? This was a remarkable case of collaboration and a very effective case of collaboration, but I think the anticipatory issues are the bigger issues that you folks are going to have to deal with.
I thank the panel, and this has been very useful. We'll take the next panel now.
What happened to it?
I thank the panel. Apologize for the delay in getting to you. There's a lot of interest in the subject. We will begin with Ms. Leslie Norwood, who's Managing Director and Associate General Counsel of SIFMA. Ms. Norwood.
Good morning, Chairman Frank and members of the committee. My name is Leslie Norwood, and I'm Managing Director and Associate General Counsel of the Securities Industry and Financial Markets Association. I serve as staff advisor to the association's Municipal Securities Division. Thank you very much for the opportunity to testify on the auction rate securities market today. The credit crisis over the last 18 months is like none we have ever experienced before. As problems in the mortgage market spread into mortgage securitization in 2007, faith in the monoline insurers, insurers of mortgage bonds, and collateralized debt obligations began to waver. Investors became wary of being exposed to anything with the potential for downgrades, including any securities connected with the insurers themselves. Because of the critical role the insurers play in the ARS market, the demand for ARS and other variable rate securities began to show signs of decline, and the number of failed auctions increased. While it is not the first time ARS auctions have failed, this is the first time a significant number of auctions have failed. Between 1984 and 2006, only 13 out of thousands of municipal securities auctions failed. By contrast, 31 failed municipal securities auctions are estimated to have occurred during the second half of 2007 alone. As the demand for ARS began to evaporate in 2007, many broker-dealers purchased ARS in order to support the market and prevent failed auctions. Pursuant to the terms of the legal offering documents, broker-dealers were not and are not obligated to support an auction. As the credit crisis began to impact the liquidity and capital of the broker-dealer firms, many firms lacked the capacity to continue supporting the ARS market. The issues in the ARS market are unprecedented, and the flow from overall securities issues in the financial markets. While SIFMA cannot speak to the specifics of the sales and marketing practices of the various firms, it is fair to say there were deficiencies in the market. I'm sure you will hear many anecdotes about sales and marketing practices. It is important to remember that the liquidity problems in the ARS market are a result of the ongoing credit crunch. While there were disclosures made to customers about the risks associated with ARS, in hindsight, the disclosures could have and should have been better. As the committee is aware, several firms have settled or are in the process of negotiating settlements to buy back ARS to provide liquidity to investors. While it is of little comfort to investors expecting liquidity, for the most part, ARS issuers are still to this day making interest and principal payments on securities to investors as they come due, and the underlying credit ratings of ARS issuers remain high. The ARS failures have left issuers to face steep increases in the cost of capital. Some state and local government issuers of securities have found their securities resetting to maximum rates as high as 20%. The high maximum rates compensated the investors for their loss of liquidity and encouraged issuers to refund these securities into a more cost-effective form of debt. As stated earlier, in 2006, the SEC settled with 15 broker-dealer firms for auction practices that were not adequately disclosed to investors. In light of the settlement, SIFMA developed the best practices for broker-dealers of auction rate securities, which describes the role of the broker-dealer in an auction. SIFMA also created the SIFMA Auction Rate Securities Indices to serve as a benchmark for issuers and investors. SIFMA and its member firms have sought action to ease the regulatory burdens which hampered efforts of the municipal issuers to redeem or restructure their outstanding Rs. SIFMA and its member firms are helping issuers to restructure their Rs. In addition, over the last few months, a number of firms have agreed to buy back securities at par value from customers. However, many firms are facing capital limitations as a result of the continuing credit crunch, limiting the funding available to buy back outstanding Rs. I would like also to note that not all firms have the same level of activity in the Rs market. Some firms underwrote securities, some firms acted as selling agents, and other firms merely had these securities transferred to them from other firms due to customer account transfers. Many firms also face regulatory constraints. For instance, if a broker-dealer holds inventory of a particular Rs issuer, its affiliate bank is limited in how much credit assistance it can offer a distressed issuer because of Regulation W, which limits the size of covered transactions. A safe harbor from Regulation W for these firms would allow banks to buy back more of their outstanding Rs. SIFMA and the broker-dealer community are also actively working with the MSRB, the Municipal Securities Rulemaking Board, on its new disclosure system for Rs and VRDOs, which will expand their new disclosure system called EMMA, the municipal securities version of the SEC's EDGAR. In conclusion, auction rate securities were an attractive source of funding for state and local governments and student loan financing authorities for over 2 decades. But tightening of the credit markets led to a sharp decline in the demand for Rs and ultimately resulted in failures across the Rs market. The broker-dealer community is working to return the liquidity to the Rs market and to assist issuers in refinancing and structuring their Rs as quickly as possible. Thank you for the opportunity to testify before you today, and I look forward to answering your questions.
I'm now going to go a little bit out of order, and I would ask unanimous consent that we allow our colleague from New Hampshire, Ms. Shea Porter, to sit with us. I hear no serious objection, and therefore she is allowed to do it. I should note that because of the situation involving New Hampshire and education, Ms. Shea Porter has been one of the members most active and energetic in calling on us to do what we could to facilitate this, and I would now call on her to make a statement and introduce the next witness.
Why don't you move over and use this one?
Wasn't going to say anything bad either, you know? Thank you. Okay, we'll try again. Thank you very much, Mr. Chairman, and thank you for the privilege of joining you for this important hearing. I am pleased to have the opportunity to introduce a fellow New Hampshireite, Ms. Tara Payne. Ms. Payne is here to share with the committee the New Hampshire Higher Education Assistance Foundation, or as we call them, NEAF's, experience with the auction rate securities. The NEAF network is made up of 4 nonprofit organizations that collectively serve as New Hampshire's leading provider of college planning and funding. She has worked for the NEAF network since 1996 and currently serves as the Vice President of Corporate Communications and Marketing. Thank you so much for being here today, Ms. Payne. I look forward to hearing your testimony. And thank you again, Mr. Chairman, for the opportunity to participate, and I yield back.
I thank you, and I should point out that we have had a great deal of cooperation here between this committee and the Committee on Education and Labor, which has a specific interest in education. And one of the things I'm proud of in this Congress is that we really avoided, I think, the kind of jurisdictional hair pulls that just annoy everybody and shouldn't happen. And with regard to the impact of auction rate securities on education funding, we've been able to be cooperative. I appreciate the Education and Labor Committee having worked with us. I know they've had some constructive results, the chairman tells me, in dealing with the Federal Department of Education. So we are glad to do this. Ms. Payne, why don't you go ahead, and then we'll get back to the others.
Thank you. Chairman Frank and Ranking Member Baucus, members of the committee, I am Tara Payne, representing the New Hampshire Higher Education Loan Corporation. It is an honor to participate in these discussions. I would like to thank the representative from New Hampshire who continues to be a strong advocate for student access to higher education. Thank you. Thousands of schools and millions of students have relied upon FELP providers to finance post-secondary costs. In our capacity as a nonprofit student loan provider, NELCO takes great pride in educating students about responsible borrowing. Consequently, we consistently have among the lowest cohort default rates in the nation. When students successfully repay their federal loans, everyone benefits. Taxpayers don't have to shoulder the burden of increased federal debt to cover loan losses. Schools maintain their eligibility to award federal financial aid. And best of all, students realize the full benefit of the investment they have made in higher education. The FELP community is dedicated to promoting college access, particularly for underserved students, and it does so by offering an extensive array of college outreach programs. The impact of these programs is enormous and widespread. Consider that in New Hampshire alone, 95% of public high schools and 34,000 students and parents relied on the services we provided last year. And I must stress the importance of having agencies such as ours across the nation. One of the unintended consequences of the legislative cuts to subsidies for nonprofit lenders and the current liquidity crisis is the risk of losing programs like the Center for College Planning in New Hampshire. Access to college begins with increasing aspirations, but it ultimately ends with the availability of financial aid programs and funding options. We are proud of the integrity and commitment we have made to these programs, but in this year, fulfilling our most essential mission has been extremely challenging. NELCO is New Hampshire's leading provider of student loan financing and funded $184 million in federal loans and $67 million in alternative loans in FY07. In all, NELCO has $1.5 billion in outstanding bonds, which have funded our program since 1997. The auction rate market has been an important key source for liquidity for student loan lenders. For the last decade, NELCO borrowed money to fund loans by selling auction rate certificates. However, investors no longer are investing in the auction rate market, thus issuers like NELCO can't raise capital to fund loans. Our organization has always held itself to a high standard of financial accountability. We recognize that we bear responsibility to ensure that whatever taxpayer money is spent on our program is minimal, and that access to higher education is made possible through our sustaining a strong financial base. This strong base has been significantly compromised by NELCO's longstanding trusted financial advisor, UBS Securities LLC. On August 14th, the New Hampshire Bureau of Securities Regulation announced that it was taking action against UBS for fraud. The action relates to UBS's representation of NELCO in the sale of bonds. Essentially, the order issued by the Bureau states that UBS knew that the market for these bonds was on the verge of collapse. At the same time, UBS was actively encouraging NELCO to extend its commitment on these bonds. UBS advised NELCO to reset the maximum rate on NELCO's taxable bond to 17% to 18% to ensure liquidity and prevent auctions from failing. We now know this was a scheme. It was a scheme to make the securities more attractive to investors and to keep NELCO in the market. UBS never disclosed to NELCO that the market was at risk of freezing and that the maximum interest rate payable on the bonds could lead to NELCO's financial harm, or that UBS was preparing to end its support of the market as it had always done. On February 13, 2008, UBS stopped supporting the market and it collapsed, leaving NELCO and investors with billions of dollars frozen. We support the New Hampshire Bureau in its assertion that UBS failed in its fiduciary and moral duty to NELCO. Alternative loans have become a key factor in affordability and access. NELCO's non-federal alternative loan program provided funding to close the gap between what students receive in financial aid and what the college actually costs. In FY07, over 6,000 students borrowed $67 million through our alternative loan program. Still, recognizing the severity of the liquidity crisis, the reduction to lenders from recent legislation, and the lack of viable solutions from our financial advisor, NELCO was forced to suspend its alternative loan program in March, leaving thousands of students to search for other alternatives. Any interruption in the loan program hurts college-bound students. It causes a disruption in financial aid delivery and creates another layer of complexity to a tedious financial aid process. Naturally, this has the greatest impact on our most vulnerable students. Following our suspension of the alternative loan program and becoming gravely concerned about our ability to fund even federal loans, NELCO asked the member institutions of the New Hampshire Bankers Association and New Hampshire credit unions to provide liquidity that would enable NELCO to fund the federal program. Currently, $94 million has been raised, and I can assure you that NELCO would have suspended its federal program if it were not for the overwhelming support of community lenders to provide a temporary solution prior to the Ensuring Continued Access to Students Loan Act. Thank you sincerely for your time.
Thank you. Next, Mr. Roger Sher, who is the Vice President of Shared Development Corporation.
Sorry. Roger Sher, Vice President of Shared Development Corporation, a Michigan-based real estate company that has been creating retail and construction-related jobs since the mid-1980s. Appreciate the opportunity to address this committee. My purpose is to describe how Comerica Bank's misrepresentation regarding auction rate preferred securities purchased on our behalf has harmed our company, individuals who would have worked for our company if not for the misrepresentation, our community, and the overall integrity in the financial system. In 2005, our company sold a number of retail shopping centers. At that point, we had an unusually large cash position. Our intent was to park those proceeds for a relatively short period of time, intending to pay capital gain taxes, and then redeploy those monies in other projects as opportunities presented. Our goals for the funds were safety and liquidity. We made those goals clear to Comerica Bank, which has served as our family's and company's bank for over 60 years. Comerica directed the purchase of specific auction rate securities as a place to park those funds. Comerica sold these securities as cash equivalents. There was no disclosure of any risk to liquidity or value. The particular securities we now own are listed for you in my written testimony. In February of this year, we were stunned to learn that as a result of the freezing of the market for ARPs, our funds placed by Comerica were no longer available to support our ongoing business operations. In multiple letters to Comerica officials we requested the bank to follow through and give us our promised cash on demand. Even though Comerica selected the specific securities we purchased and earned healthy commissions, they refused to shoulder any of the responsibility for their misrepresentation. Until recently, Comerica has repeatedly refused to repurchase these securities or participate in any settlements with regulators. We now understand, as of this morning, Comerica has agreed to cooperate with regulators and repurchase the securities that it sold to retail investors. We only hope that this would have come more voluntarily from Comerica without regulators and enforcement officers breathing down their back at a significant cost to taxpayers. Having cash on hand provides important competitive advantages for a firm our size. It allows us to move quickly and pursue projects we may not otherwise have been able to do. To the extent retail opportunities we pursue create jobs in America, the liquidity of our balance sheet is important. It may be of interest that in the past, Share Development has completed retail and residential-related projects with aggregate values exceeding $250 million. As a result, thousands of jobs have been created and millions in taxes have been paid. The Michigan economy is facing some difficult times today. Comerica's failure to fully correct the illiquid condition at our company has directly contributed to tough times in Michigan. One investment, for example, we would have pursued is the development of a large shopping center in the city of Detroit. It would have provided needed retail services for people living in the area, as well as hundreds of high-paid construction jobs and hundreds of retail positions. Because our funds are still locked up with these auction securities, we're not able to make a rapid decision and pursue this project. As of now, the site remains undeveloped. Residents in the area need to travel further distances for the groceries and other goods they need. Others in the area may remain unemployed or underemployed. Comerica Bank has $60 billion in assets, ranks as one of the top 20 banks in the country. It advertises that it puts its customers first, has hundreds of branches to serve you. Unlike Goldman Sachs, Merrill Lynch, or UBS, Comerica is a hometown regional bank trusted to sell safe products designed to protect their customers. Comerica's customers have a good reason to hold them to a higher fiduciary standard of care than is applicable to brokers in the fast-paced world of investment banking. Comerica sold more than $2 billion of these securities to individuals, municipalities, and firms like ours that pay taxes and create jobs. Clearly, given the resources and sophistication of the bank, they should have understood and accurately communicated the types of securities they were selling in large volumes. If they had advised us and other customers of the true nature of these securities, they would have not have been purchased as money market instruments. Like any retailer, they should be held responsible for their misrepresentation. It is important to note that judicial remedies alone are not sufficient here. If we and thousands of other firms, municipalities, and individuals are forced to go to court for justice and wait months, if not years, to be heard, the economy will suffer in the short and the long term. In the short term, without access to funds, firms like ours cannot create desperately needed jobs. In the long term, trust and confidence in the banking and regulatory system, which is now facing a critical challenge, will be further eroded. In conclusion, many firms such as ours relied on their local bank for sound, conservative money management advice. In this case, Comerica sold auction rate securities as cash equivalents and misrepresented the products they sold. As a result, our business has been damaged, we've been unable to create needed jobs, and the trust in the banking system has been undermined. Thank you.
We have Mr. William Adams IV, who's Vice President of Nuveen Investments.
Chairman Frank, members of the Financial Services Committee, thank you for inviting me to testify about the continuing turmoil in the auction rate securities market and about possible solutions. We commend you for holding hearings on this important topic and appreciate the opportunity to express our views. My name is Bill Adams. I'm Executive Vice President of Nuveen Investments. Nuveen-sponsored closed-end funds together represent the largest issuer of auction rate preferred securities, and we share the committee's deep concern over this issue and its impact on investors. 100 of our closed-end funds had more than $15 billion of auction rate preferred shares, or what I'll call ARPs, at the time this market failed in February. Since the failures began, my team has worked very hard to resolve the problem for our fund's shareholders. The failed auctions have prevented tens of thousands of Nuveen shareholders from selling their ARPs and have increased fund financing costs for the fund's more than 1 million common shareholders. As you and your constituents well know, this problem has created significant financial hardship for many preferred shareholders. Following the breakdown of the ARPS market, Nuveen and the fund's independent directors determined that it was the absence of market liquidity rather than credit concerns regarding our funds that caused the auction failures. We also concluded that the existing ARPS market was unlikely to return to normal. In March, Nuveen and the funds announced that they would seek to refinance all the fund's outstanding ARPS. Our goal was to reduce the fund's cost of borrowing for the benefit of common shareholders while providing liquidity at par for the fund's preferred shareholders. Since then, we have kept all our shareholders fully informed of our progress and the challenges we face. The unprecedented turmoil in the financial markets has made it even more challenging. Still, we have made significant progress. To date, Nuveen's closed-end funds have redeemed or have announced their intention to redeem nearly $5 billion of their $15 billion of outstanding ARPS. So how have we refinanced the ARPS? Our first approach has been to employ conventional financing methods to the greatest extent possible. This includes bank loans, lines of credit, and other forms of secured lending, as well as tender option bonds. Most importantly, we have created a new form of preferred stock called Variable Rate Demand Preferred, or VRDP. This new security offers two critical benefits. One, like the ARPS, it allows our municipal closed-end funds to obtain financing at favorable tax-exempt rates. And two, because of the liquidity backstop from a bank, VRDP is eligible for purchase by tax-exempt money market funds, the largest buyers of short-term tax-exempt securities. In fact, we recently sold $500 million of this new preferred stock to refinance all the ARPS for 4 of our funds. And we believe there is a lot more demand from money market funds that could allow the Nuveen funds and potentially all closed-end funds to refinance all ARPS to cash out ARPS shareholders. We appreciate the guidance we've received from the SEC and the Department of the Treasury and the sense of urgency this committee has imparted on regulators and market participants to find creative solutions. We've made progress, but clearly there's more to be done. We have learned through our discussions with banks and institutional investors that a number of regulations continue to limit our fund's ability to issue larger amounts of VRDP and resolve this issue more quickly. I would like to end by highlighting 3 suggestions. The first would be for the Federal Reserve to broaden the ability of banks to own VRDP in their role as liquidity providers, and to permit banks to pledge VRDP as collateral at the Fed discount window. This would remove the obstacles that have limited the ability of banks to provide liquidity backstops for VRDP. Second, the SEC should expedite its consideration of relief under the Investment Company Act to temporarily permit closed-end funds to use debt financing to a greater extent than currently permitted. And third, it would help if the Treasury Department would further clarify the equity treatment of preferred securities that include liquidity backstops, and to permit not only fixed income funds, but also equity funds to issue such preferred securities. Again, thank you for the opportunity to explore these issues and potential solutions on behalf of the millions of investors caught up in this unprecedented situation. I look forward to answering your questions.
Thank you. And finally, I'm going to step in for my colleague, the second-ranking member of the committee and the chair of the Financial Institution Subcommittee, Mr. Kanjorski, who wrenched his back today. He is unlike most of the people concerned with the financial service industry today in that he has a pain in his back. I am therefore glad to introduce a man who he has worked with, I know, closely, and who appeared with us at the press conference earlier on when we announced this hearing. And I have to say that as important as this hearing is, I think our having announced it a couple of months ago was probably the biggest contribution we made to getting things moving. But James Preston is President and Chief Executive Officer of the Pennsylvania Higher Education Assistance Agency. I know Mr. Kanjorski welcomes the assistance he's given us and advice, so please, Mr. Preston.
Thank you very much. I'm Jim Preston, President and CEO of Pennsylvania Higher Education Assistance Agency. I'd like to thank Chairman Frank and Ranking Member Backus for holding this hearing. I'm especially grateful to Mr. Kanjorski for his leadership on the student loan aspect of this important issue and his support of a comprehensive solution to the student loan liquidity issue. As someone with more than 25 years of investment banking and student loan funding experience, I can attest that today's situation is unprecedented and is in urgent need of attention. The fact is, nobody knows how long it will be before today's problems become too deeply rooted to be resolved without extensive government intervention. The collapse of the auction rate securities market and the dysfunction of other markets, which might have proved or provided alternative sources of funding for not-for-profit student loan secondary markets, have left nonprofit agencies with few, if any, ways to raise needed funds that students and families depend upon to meet college costs. In May, Congress took a first step by passing the Ensuring Continued Access to Student Loans, ECASLA, which has been crucial in assuring access to federal student loans for this fall. And last night, passed again to extend it for one more year. However, this act is little more than a temporary solution and applies only to federally guaranteed student loans. Unless Congress and the administration address the underlying cause of the current liquidity difficulties, there will be continued instability in the student loan marketplace. In March of this year, FIA reached the conclusion that we must suspend origination and purchasing of federal student loans. The cost of raising capital to fund student loan originations and purchases had become financially impossible. There was no way to generate a positive return on our investment, and additionally, traditional sources of liquidity were withdrawn and just not available. We simply could not sustain unlimited losses and continue to provide access to student loans and maintain essential services to the citizens of Pennsylvania. To finance the loans we have made and purchased over the years, FIA maintains nearly $12 billion in outstanding debt obligations. These obligations take many forms and involve a mix of both taxable and tax-exempt. Approximately $7.4 billion is in the form of auction rate. FIA uses these funds to originate student loans and to serve as a secondary market for student loans. By providing a secondary market purchasing loans from originators for par plus a reasonable premium based on the value of the loans, FIA enables hundreds of lenders to participate in the federal student loan program. These lenders, which rely on secondary markets to recycle their funds in order to make new loans, now find themselves with no outlet for the loans they originate. Their balance sheets are filling up rapidly, which cannot be continued indefinitely. Today, we find ourselves unable to issue new debt obligations due to the lack of investors, and because even if investors are found, the price required is too high to allow issuers to make or purchase loans without losing money on each new loan. Additionally, rating agencies and credit providers are demanding that debt issuers add substantial capital of their own to any new security, which is a significant obstacle for those of us without access to funds. We realize that any effort to provide vehicles to fund student loans must benefit three groups: the investors who find their assets trapped in these investments, the issuers who are unable to refinance these securities, and the federal government, which should not bear any financial burden as a result. Earlier this year, FIA, in concert with two sister agencies, put forward a proposal to Treasury that we believe would accomplish all three of these objectives. Since then, Treasury has adopted the core principles of this proposal, but has done so not for student loans, but for mortgage-backed securities as part of its rescue of Fannie Mae and Freddie Mac. Treasury's plan is to create a new market for mortgage-backed securities, in essence, to stand in place of the global markets, which are unable to supply sufficient capital to support the homeowners of this nation. Our proposal is for Treasury to do the exact same thing for student loans. In Treasury's fact sheet that accompanied their announcement on September 7, 2008, Treasury stated clearly that taxpayers will benefit from this program directly through potential returns on the Treasury's portfolio of mortgage-backed securities. We believe these same principles would apply to a program to purchase student loan-backed securities. And since FFELP loans are already 97% guaranteed by the federal government, such a plan would be 97% less risky for the federal government than actions that involve non-guaranteed assets. Overall, guaranteed student loans are reliable, performing assets, and they are not subprime loans. Earlier this year, Treasury advised Congress that it requires new statutory authority to purchase student loan-backed securities. Thus, we urge you, Mr. Chairman, and members of the Financial Services Committee to provide Treasury with such authority. You can do so by adopting H.R. 5914, sponsored by Representative Konjorsky. Please give us the chance to solve this issue before too many players are forced to end their participation in the student loan program to the detriment of millions of Americans. Thank you for allowing me to appear here today.
Thank you, Mr. President. I want to say, and I really appreciate your participation. This has been useful. We have some votes. They're going to take an hour. We're not going to ask you to stay. I am going to ask Ms. Shea Porter if she has a question. I do, again, I think the willingness of the people here to participate in this hearing has moved this ball forward. We will be looking at your hearing and your testimony, and we'll try and do some more. But Ms. Shea Porter will have time for questions.
Thank you, Chairman. Ms. Payne, I did want to ask you, the collapse of the market clearly had a significant impact on NEAF. It was around this time that the auctions failed that NEAF announced it was suspending its alternative loan programs. How many students were impacted by the suspension, and what has happened to them?
Well, at this point, there have been over 6,000 students who last year participated, who this year could not, and had to find other alternatives. Right now, we're actually doing a survey to find out where those borrowers have landed. However, we know from past surveys that 28% of students, even prior to the crisis, were putting tuition on credit cards. I can only imagine that that number has increased, particularly now that parents aren't able to get, say, second mortgages. It's become more difficult for those private loan providers out there. It's still become more difficult for students to access money because of tightening credit restrictions. So we're not sure exactly, and I think that we may see a big shift second semester as well. Students were able to use summer earnings to manage through first semester. We'll be interested to see what happens by second semester as well.
So do you suspect that not only are they taking the debt on credit cards, but that maybe some of them aren't even trying to go anymore, that they've given up on the idea?
Again, only through stories that we've had through families who've come into our office overwhelmed by this. We know that kids definitely were able to get some funds through other lenders, national lenders perhaps, but at what price? I mean, certainly for a much higher price than they were through a nonprofit agency. And that'll flush itself out, I think, by mid-year.
Okay, thank you, and I yield back. Thank you.
And finally, on behalf of our absent colleague, I believe the gentleman from New York, Ms. Maloney, has some questions.
Just very quickly, Mr. Preston, earlier this year, Congress passed the Ensuring Access to Student Loan Act to ensure liquidity in the student loan market. And while this has been beneficial to many lenders, other smaller nonprofit lenders still have much of their now illiquid auction rate securities. And what is being done to help these smaller nonprofit lenders, and what more can be done for them to ensure that they can continue to lend to our students?
The small nonprofit lenders play an important part of the overall delivery system in the U.S., not only for origination directly to students, but also buying from banks to participate. And it's very important to keep the banks in this business to support the higher education program. What we're finding, just like many of the small secondary markets in the United States and the not-for-profits, is that there's no financing alternatives available. We can't, for example, when the auction rate started to deteriorate, many of us, all of us probably went and started lining up bond insurance and letters of credit to refinance. I was in New York, January 18th, MBIA and AMBAC got downgraded. That day was a threshold event because then all the options started going away. And by February, the auctions then started failing. So whether it's a big or small not-for-profit, we're all in the same boat, and it's all affecting the whole chain of delivery of student loans through the banks.
Well, on that point, could anyone on the panel speak on the point that he raised on why the auction rate security market froze back in February? And then going forward, what reforms do you believe the auction rate security market needs to be made viable again so that we can continue these student loans and other activities? Why did it freeze in February?
Well, I'll take a shot at it. I think it froze because it became apparent there weren't other alternatives available to refinance, and that it just became a point of diminishing returns for those holders. And if I think the auction rate market is not a viable product now or in the future. If it does come back, it'll have to come back at a specific institutional product where the risks are clearly understood and they're willing to hold it. But I just don't see that product as being viable. So solutions going forward will have to be the variable rate demand note market coming back, which is insurance and liquidity from the banks, and the floating rate note market, which is the overseas market. Those are our only option to finance variable rate products, both tax-exempt or taxable, and until those stabilize, we don't have any options to refinance.
I thank the panel. If there are any further comments you want to submit later, we will take them. Again, I think this has been useful, and I think, I'm sorry, the gentleman from Colorado.
I just want to thank the panel, and I also want to, often our Congressional Research Service goes overlooked. They've put a heck of a report together that we got as of today that kind of goes through the chronology of this and is very instructional. So I think for everybody on the panel, as well as the members of our committee, and you guys often go overlooked. You do a great job in helping us understand these things. Thank you, Mr. Chair.
Well, I appreciate that. And I think, as I said, we've gotten some resolution on the current situation, although not to everybody's satisfaction. They weren't entirely satisfied. As for the future, while this specific instrument is probably not going to occur, we have, I think, learned some lessons about what we should put in place if anything similar shows up. I thank the panel, and the hearing is adjourned.